Welcome to another episode of Insurance Gone Wild. This is Dennis Settlemeyer, or I am Dennis Settlemeyer, not this is. Have you met Dennis? He's a good guy.
Jeez.
And this is Stephanie.
What? And I am lovely, damn it.
Oh, and lovely. And lovely.
And your co-host. So there you go. Yeah.
And the co-host, Stephanie Lencioni, my lovely co-host. Wow. Crazy.
Been a long week.
Been a long week. That's our new thing, or not? It's old now.
I don't think it's new.
It's been a long week.
It has been a
What
long
day is it? It's Monday, about 10 o'clock. So no, it's later than that, but
it is.
It's 4. I'm teasing.
Yeah, and Tuesday.
It's later in the week.
Did you know it's Tuesday?
Is it Tuesday?
Yeah, I just wasn't sure if you actually knew that.
The days are all blending together.
They are.
Yeah.
They are.
Wow. Well,
where do we go from there?
I don't know. What an introduction. What an introduction.
It was something.
Well, we were going to talk about something that's very, 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 very important today. Matter of fact, it's something that we've spoken about one other time, I think, but I don't believe that we cannot overly emphasize how important it is.
I would agree.
Would you agree?
I would absolutely
agree. Stephanie, what is the absolute most important insurance that a person can have?
That would be life insurance for $500, Dennis.
That's right.
Yeah.
Life insurance. It is. It literally is the most important. All of this other stuff that we talk about is, you have to deal with on a daily basis, but life insurance is definitely something that everybody needs to consider, everybody needs to think about, and everybody should have. It can be used for a lot of different things, because some people, we talk to and they'll say, well, I don't know how they would, I know what they say. I'm trying to be nice about it, but
so we get a couple things.
There's no living benefit, but there is a living benefit to some life insurance.
Right. So we'll go over a couple of the things that we hear, the objections as to why, somebody says, I don't need that.
Mm-hmm.
Well, what do you mean I pay all this money, and then if I outlive the policy, that's it? Mm-hmm. So I've just wasted my money. Well, okay, that is one way to look at it, but no, that is not the way that we think you should look at it. It's peace of mind. Mm-hmm. It's covering the what if. It has a job, right? It's a vehicle that has a job for that period of time. Because if you're still here, then you're still able to provide for your family. Mm-hmm. But if you weren't here, then that's when it kicks in, because you're not able to provide for the family. So that's number one. What do you mean I pay all this money and then I get nothing out of it, right? I'm wasting money. Mm-hmm. It's crap. Number two, man, I hear this with spouses a lot, and I am going to tell you, I do typically hear it from men. I don't want my wife getting rich off of my death. Mm-hmm. Right? And you're like, well, that got weird. That's super weird, because you're the breadwinner. In these cases, when the guy says it, they are typically the breadwinner, usually a stay-at-home mom, usually in this case, and usually 3+ children that are all like slammed together and young at the time. And I'm like, wow, that's actually also a terrible way to think about it. But yeah, we're not getting rich. I mean, if I have somebody with a young child and they want just $1 million, I'm like, that's a start. Mm-hmm. That's a start. I mean, if something happens to you in the next 5 years, that means you still have, if you've got a 5-year-old, something happens in the next 5 years, that's at least another 18 years, I'm sorry, not 18, but 8 to 12 years that this child is still going to be, under financial dependency from a parent, right? And then these days it's really, you still have 15 to 20 more years. And then the household has to still operate and maintain. Correct. And then there's an adjustment period. There's a lot going on, and it's not about getting rich based off of somebody's death. It's about, can your family continue to sustain itself? Will they not have to be, their life has already been disrupted. tremendously. So now how do we keep everything else calm?
Yeah, I think in going with that is I don't believe that most people understand that it costs $300,000 to $400,000 minimum to raise a kid from birth to 18 years old. $300,000 to $400,000 minimum.
Okay.
And I say minimum, that's probably no extracurricular activities, that's probably a healthy child too. What if you have one that, has health issues? That's going to cost extra. So even $1 million insurance policy, you're not getting wealthy. The wife isn't getting wealthy off that.
No,
she's not getting
we're
wealthy
not.
off of it.
No.
So, because money doesn't go as far as it used to.
Exactly. And again,
You tried the price of eggs. We want to go down that road again?
I can't.
Okay.
I can't.
All
I don't
right.
wanna
But
do that
no,
to the
you get what I'm
listeners.
saying. Just groceries alone, electricity, things like that keeps going up and up and up. And so $1 million, this is crazy to say, but does not go as far as it used to.
No. And especially when it has to be stretched out over a period of time. And then to your point with inflation,
Yeah.
if they're still under the roof for 10 years, well, by year 10, the million is worth even less than when it actually was written. And that's
Significantly less.
And that's assuming there's only one child.
That's correct. I said 300 to 400 minimum per child.
Exactly. And there aren't many households with just one child. So it's, but even saying that though, I will say something is better than nothing. And there are certain cases where it's like, we've talked about this, like, oh, I can't afford it. Right. That's another objection. We're like, well, if you can't afford it, then you can't afford to not have it. Right. Like if you can't afford an extra $40, $50 or whatever it is. And that's the thing too, we can go through a couple quick quotes just to give the listeners another example of it. It's a lot less expensive than a lot of people think, especially if we have no health issues, if we're not a smoker. But then even if you are, $100 a month, $150 a month to protect your family and their livelihood if something were to happen to you, is it worth it? Like, where could we cut? Right? Everything is a lot more expensive. And if you got something like a term, that's locked in. So your 150 is always going to be 150 until the end of the policy. It's not like eggs where hey, well, maybe we'll pay $2 today and then $9 tomorrow for the next 6 months. Like, it's going to be a flat rate depending on the policy, right? So anyway, I feel like we've gotten off topic from where we were trying to go.
I think
we went off path.
We're
on topic, but we've gone off path
Yeah.
of the intention.
But I think you had looked up some things about life insurance. So let's kind of go through that and we'll give our 2 cents on it. And you need to know that somebody else may have a different opinion, but this is our 2 cents on it. Let me back up. This is a very basic 2 cents because we don't know what everybody's different situations are.
I think that's a great disclaimer.
Yeah.
So based on everybody's situation, different.
Yeah.
But just from a straight, so it says life insurance strategies for insurance, right? And it's going to give us a various strategies we'll discuss. So yes, not saying like, what is it? It's not the end all be all. Like we're not dying on a hill on this, but we're just giving our thoughts on it. Okay.
Yeah.
So the first is buy term and invest the rest.
Yeah, that is usually not going to work. Now, let me back. This is my opinion. I think that is a great strategy for people that are disciplined enough to do it. The problem is the majority of people are not disciplined enough to invest the difference. They don't even know what the difference is, number one, between $100 and $300, depending on what
Right.
we don't know what that difference number is.
Right.
Because people don't investigate it that enough. They just go, well, I'll just buy term and I'll invest something.
Right.
No, you invest the difference, whatever that difference is. But again, it's all about discipline. I will say that I think Dave Ramsey I agree with most of his stuff except life insurance. He's like, buy term, don't buy permanent, because term's very cheap. Permanent's much more expensive, and the fees and stuff that are inside it, we can get into all that are charged back to you. But if you follow Dave Ramsey's plan to the letter, he is 100% correct. You buy term. By the time you get to where you're 60, 65 years old, you no longer need a permanent policy because you've got enough in savings and investments and things like that. You don't need it. Here's the problem. Only a small percentage of people actually follow his plan or Susie Norman or whoever else's plan is out there to the letter. And so those folks have never had to sit across the table from somebody that just retired and says, I need $300,000 of life insurance for me and my wife in the event that I die to pay off the house, whatever. And you look at them and go, that's $500 a month.
If you qualify.
Yeah, if you qualify. And they're like, what? Yeah, it's a whole different conversation. And again, Susie and Dave and some of these other people out there, they're not wrong. It's not practical in most cases. It's my opinion. That's my opinion, is that they've never had to have those conversations with folks at the end.
Yeah. And I guess, to go off of what you were saying, it's that people will squirrel, right? Maybe they're super committed at first and then something happens and maybe inflation goes up, maybe COVID happens, maybe this happens, maybe that happens, whatever the case is. But then they're derailed. And now the plan is no longer a functioning plan. So, but I do think, again, if nothing else, that term is huge.
Oh,
the term is huge.
I'm okay with term. I'm okay with term. I have zero problem with term. I think term is a great product. If you're a young family and you literally don't have a lot of money, get term. But at some point, start throwing at least some permanent in there. It doesn't have to be $1 million a permanent, just some permanent in there to get you past. Because once you get a certain age, 60, let's say 65, I'd have to look at the numbers. But your cost of your term and the cost of whole are starting to get closer and closer, or permanent are starting to get closer and closer and closer. So why not just go ahead and get the permanent? So get the permanent as early as you can because it's cheaper.
Right.
But the term is certainly something that's there because you can buy it for pennies compared to a permanent policy, especially when you're young.
Oh, yeah.
But if you buy a permanent policy, and we won't get in, I don't think we're going to get into all the different types of policies, but you get some sort of a universal life policy that accumulates cash along the way. You can put it and take it, and as you start calculating retirement, you can put some of that, it's not a investment vehicle, but it is a way the money that accumulates in there can be taken out tax-free under certain conditions. So and you can use it in your retirement planning. That's what I went to say. You can use it as part of your retirement planning. So don't discount the benefit of whole life. I keep saying whole life, permanent insurance.
Right.
But because it has a place, but term, I'm not down on term at all. I think term is very, very important to have because you can get so much of it, especially if you got kids. 20 or 30 year term to get enough to cover the kids to they're 18, 20 years old, where they can get out on their own, take care of themselves. So, what else? I don't even remember the question. I buy term, invest the difference.
Oh, the child policy strategy. So I would hear a lot when I would bring this up to not small families, but young families, right? Or just really any family, if their kid is still a minor, that you start that permanent policy on them. And they're like, and it's a touchy, it's a dicey topic to come up or to bring up to somebody, because they're like, I don't want to profit on my child's death. And you're like, man,
that is one of the most, I hear that often, and it's like nails on a chalkboard. They don't get it. It just tells you that they don't understand what they're saying and the importance of life insurance. You're talking about setting up a permanent policy that grows,
accumulates cash value
over a period of time, so that when they're 60, 65-year child, if they just continue to pay that same premium, they could have $1 million sitting in a cash account.
Now they got a retirement fund.
Yeah.
Like, or you have access to loans without having to go to a financial institution.
Correct.
And prove all of your income and do this and do
Loaning
that and
stuff
whatever.
loaning money to yourself.
Yep. So there are a ton of benefits, but I think that also that's where the responsibility falls on the agent, right? Or the advisor or whatever, when you're talking to them and you're like, and it's the mindset of, hey, yeah, that life insurance is exactly that. It is insuring your life, right? And we're assigning a face value to that. But man, what does that mean? What is it actually doing? And then with the kid thing, number one, it's doing guaranteed insurability.
Yes, that means they will have insurance. If they get something later that would disqualify for them getting life insurance, well, guess what? They've got it now.
Right.
They used to have something.
We've got Cook Children's there. What am I thinking? St. Jude's, right? I mean, my goodness, so many children are diagnosed with cancer, or they have heart issues later on, or this happens or that, whatever the case is. But guaranteed insurability, type 1 diabetes, right? Juvenile onset diabetes.
That can be tough.
That they're not going to take it. Type 1, if you're insulin dependent, I've not found one.
Forster? Forster?
For children?
Will they take it? Forster's the name of an insurance company. Will they take type 1?
Once you are an adult, it's different.
Okay.
But if you're young, I don't know. To be honest, I haven't done an insulin dependent quote in a while.
Okay.
For
that's fair.
An adult, but I mean, you're susceptible to seizures, to
kidney issues, all sorts of heart issues, liver issues. Yeah, I get it.
I mean, there's a ton that goes on with that.
Yeah.
Especially if your A1C is not controlled.
Yeah.
Anyway, so guaranteed insurability, you've got the later financial, I'm like lacking for finding words today, but financial security, right? That we talked about, the retirement possibility, and then an ability to buy up. Right. So there are some policies, and it just depends on which type of policy they get. And then there's that buy up where it's like, okay, you're guaranteed to be able to increase the amount once they
every so many years.
Yeah. They hit these different milestones with ages.
That's what our girls have. I bought them is when they're 25, 28, 31, 34, 37, and 40, they can buy up with no paramedic exam, nothing.
Right. It's guaranteed issue.
Yep. Guaranteed.
So you're just paying for the increase of coverage. So yeah, I mean, there's so
okay. Well,
many
there's
benefits.
one other thing that very seldom gets mentioned.
Okay.
Is that you're not looking to profit off your kid. That is nails on a chalkboard to me, because that means people don't get it. So you have to explain it to them. Here's the other thing to explain to folks. A vast majority of couples who have a child die will get divorced within a short period of time, because they weren't able to take time off to deal with the grief and the loss and those sort of items. If you want to do something with your child's life insurance that passes away, you certainly can give it away. You can do whatever you want to do, but you can also take it and help take time off from work, go to counseling, work on yourself or yourselves as a couple, because that is a very traumatic experience for couples to lose a child.
Well, and siblings.
And I didn't even think about siblings. I always thought about the husband and wife.
Yeah, no, so I'm a huge proponent of mom and dad, husband and wife first, children second. They can be a very, very close second.
Yeah.
But yes, if you keep mom and dad good up top, then the children inevitably should be pretty good below.
Oh, sure.
But it's different, right? Like it's a different loss. And so you guys may be doing well with it. And then of course you're bringing the family in close. So everybody is just, okay, we're together, we're working through it. But what if you guys can make sense of it, but then your other children can't?
Correct.
Right. So then it's counseling for them, and I'm kind of iffy on the whole counseling thing. I think find a good one is all I'll say. But yes, but it's just huge. And I am I can't even imagine.
Yeah.
Can't even imagine having to go through it. So,
No,
but then the last thing I would want to do is have to go through it and then say, oh shit, I have to go to work because I can't lose my house or I have to pay my card, or I have to do this, or I have to do that, or I have to put food on the table to feed my other children.
You're forced to go back to work
That's
for
what I'm saying.
financial reasons.
Yeah, that's like,
yeah.
oh, I can't even imagine.
Yeah.
Can't even imagine.
Yeah.
So yes, that would be the child thing.
Okay.
Lots of really cool options out there. Life insurance actually, it can be a lot of fun when you start looking at how you can utilize it, and it can be a retirement tool, right? It's just another tool in the old toolbox for different things. It can be a lot of fun. And let me see. Yeah, using life insurance for retirement income. Most people think of 401k and Social Security. So,
Yeah, there's a thing called a LIRP, life insurance retirement planning. A LIRP, LIRP.
okay.
That's a whole what's the word I'm trying idea or strategy maybe for doing it. So you buy life insurance because life insurance proceeds, there's no tax on it, right? So if you buy life insurance, especially the kind that accumulates cash, your tax burden when you take it out or use it is little to nothing. And so you use that to buy, you're paying taxes on, you're buying life insurance with taxed dollars. It's already been taken out of your paycheck. So this is your leftover. So every $100 you buy a life insurance policy with, you're going to get back $1,000 or $10,000, whatever the number is. But that is tax free. And so the life insurance retirement planning strategy says, hey, whether it be a Roth IRA, which takes taxes out now, versus a traditional IRA that takes taxes out at retirement, go ahead and pay the taxes on it now so that when you do retire, or when they have to jack taxes up to pay for this deficit that we keep accumulating with the government, which is going to which will happen at some point, you're sitting there going, let them raise it as much as they want. I don't have to pay taxes on this stuff because I'm in retirement and I pay taxes on my Social Security, I guess, but my other stuff is all tax free. I already pay taxes on it. I pay taxes at a lower rate than what we're paying now.
Which isn't that nuts?
It is.
The Social Security part. Like
you got to pay taxes on Social Security,
and then they pay you.
Yeah, that's a whole nother deal. Because you've paid
into it this whole time, and then they pay you, and they're like, we're going to need some of that back.
Yeah.
I'm so sorry that we gave you that very small amount, but we are going to need some of that back because you're taxed.
I agree.
It is nuts.
I agree.
So take control of your retirement as much as possible.
And I think this is one of the things that when we prefaced, we don't know at the very beginning, I said, we don't know everybody's situation.
Correct.
We're giving just sort of general answers to life insurance based on these things that you're reading. We don't know because somebody may be doing what I just described, LIRP, life insurance retirement planning. And we're saying, don't discount term, it's good, or don't discount permanent life insurance, it's good, or whatever, but it doesn't fit for everyone. You got to figure out what fits for you. They're just sort of general thoughts that we have on this.
Yeah, and we get told all the time. I
get told all the time on something.
Well, people usually have an opinion very strongly about, does permanent suck or is it good, or does term suck or is it good? And it's one or the other, right? Very rarely do we find people and they're like, okay, so I need this over here, but then I really want this. I want the term, but then I really want the permanent so we can do all of these other things and da 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 da. The typical client is hard one way or the other. And Dennis, which one is better, term or permanent?
It depends.
Thank you. That's 100%.
It depends on what your need is, what your situation is. I would say that if you're a young couple with a kid or 2 or 3, I'm going to tell you probably need to get term, because you can buy a jumbo term for pennies compared to a whole life policy. Now, if you can afford both,
I would say both. At that point,
If you can afford both, then let's do both.
yeah.
Get you a big term for 20, 25 years, 30 years, whatever it is, but then get the one you can factor into your retirement planning that's going to accumulate cash so that maybe 10, 15 years down the road, you got to put a new air conditioner in your house. Well, hey, I don't need to go to the bank or borrow money. I can pull something out of my,
Yeah.
I can either pull it out or I can borrow the money out of my universal life policy or something. And I got my new air conditioner put in, because air conditioning systems aren't $3,000 anymore for a home. They're $10,000, $15,000.
Yeah. But I would say even those people who are, I guess there's a line for if, depending on how wealthy you are, but you know, the young couple with the young 3 kids and they're doing well, they're financially established really well. I mean, unless you are like really, really financially established, then you don't need the term. But otherwise, I would say, I mean, the term just, man, it just checks a great box.
I agree.
Here's your biggest bang for your buck. But yeah, no. So the point is, it just term or permanent totally depends.
Depends on what your
Just depends.
situation
Yep.
is, and we can't answer that over the phone,
Right.
or over in the video.
Right. Yeah. I mean, I think that's. I mean, there are a couple others, but we've talked about some of them,
Well,
so we can wrap on that. But
we got just a couple of minutes. One of the other things we talked is sometimes you can use life insurance in business practice. Remember, we talked a little bit about, like, you need to get a loan from the bank. If you get a, what kind of loan is it? Small business loan, a SBA loan. Almost always they're going to require that you get a life insurance policy for equal to whatever the loan amount is. And
because they want to protect their investment.
they want to protect their investment in case you die. And in that case, it can help you get a loan. If you have cash value, sometimes you can pledge the value of the cash accumulation there toward a loan, and banks will be a little bit happier with you and possibly work with you. So there's other reasons to get life insurance other than just for life insurance. Using it in business practices can be beneficial too. So anyway, you guys, if you have questions or comments, please give us a call, 817-753-0093. You can reply back to whatever social media platform you're listening on. We'd be glad to give you more of our 2 cents, whatever it may be worth. And you can also email us, contact@igwpodcast.com. It's contact@igwpodcast.com. And shoot us a message, and we'd be glad to respond to you. Thank you so much.